not go for any schemes like LIC or something where there is a lock-in, or I can redeem it only after 10 years from the date of investment. No, emergency fund should be liquid. So the next one is the sinking fund. So what is a sinking fund? A sinking fund is also called as a reserve fund. So you are at your 30s, okay? So you know that in 10 years time, what you have to do is, in 10 years time, um, you know that, one second, sorry. Yeah, sorry. So we are talking about the sinking funds. So you know, in 10 years time from now, you have to plan for some function, or your brother's marriage, or your sister's marriage, or your kid's education, for example. So you know that in a particular point in your future, you have to incur some expenses. So for that, periodically you start saving from today. It is going to be very helpful in the near future. For example, let's say a person is at the age of 35, and in the next 8 years his son is going to start his college. So what the person should do is he has to allocate some amount. For example, the son's education would be around 10 lakhs, let us say. So for that 10 lakhs, he has to start systematically investing, either a lump sum in a year or monthly, like year, month on month, a particular amount, like say 2000 to 5000, or whatever bandwidth he has. So once this amount is saved, this is not only the principal, this principal will start accumulating over a period, and by the end of the 10th year, when his son goes to the college, he will have a good corpus or a margin for funding his son's education. So sinking fund, so how do I go about a sinking fund? So this can be a fund where there is a lock-in period, because I know the particular timeline within which I will need the fund. So I can go for a mutual fund with a lock-in period, I can go for LIC. There are many cashback investments plan available with many investment companies. Or I can even go for systematic investment plans with share markets. So I can monitor a stock, I can put a monthly SIP for say 2000 or 3000 in any shares. So this will keep compounding. And in fact, we can go for a thing with a lock-in period also. So this is about sinking and emergency fund. So now we have seen the basics of the budgeting. So 50% for my needs, 30 for wants, and 20 for savings. Now when we talk about savings, I've spoken about two things: emergency and sinking funds. So what are the types of investments in which I can put my money in? So we are going to look at investments on a basis of four criteria. So what are the four criteria when you look at investments? So first, I look at the risk, whether my investment is risky or it is low risk, and then I look at the return. See,
Janani,
any, yeah.
I'm very sorry to disturb. Are you presenting your screen right now?
Yeah, yeah, I'm presenting. You're not able to see?
No, I can't able to see the presentation.
Yeah, yeah.
Okay, okay,
We
okay.
couldn't.
Yes.
Okay. Now you guys can see?
Yeah, fine. Thank you.
Sorry. Yeah. Yeah, okay. So we are talking about investments. So in investments, the first criteria which we look at is the risk and the return parameters. Any investment with a low risk is going to give me a lower return, and vice versa. Any investment with a high risk will obviously give me a higher return. And what are the other criteria? I have to look at the tenor, which is the duration. Maybe like I need funds within the next 5 years, or I need funds within the next 1 year itself. So whether it is going to be a short term investment or a long term investment. And the next most important criteria is the liquidity. So the tenor and liquidity are interrelated. Let us see. So what is liquidity? As I told you, how early I'll be able to redeem the funds if I'm in need of that. so that I don't put it in whether I want to put it in an investment which has a lock-in period or which can be redeemed quickly. So these are the 4 parameters. Now we are looking at a risk return pyramid. So we start with low risk, low return, and then we stop with a high risk and high returns. So we are going to see about each thing in the next slide. I will just give you a gist of it right now. So we are seeing about FDs and RDs, PPS, NSE, government bonds, and SGB. So what is SGB? Is sovereign gold bonds. So this first category is a place where the risk is low because all these investments are provided with a fixed rate of return. So once when you log in for this type of investment, you will be given a fixed rate of return with which you will be your maturity amount will be added to. For example, I invest 1 lakh in an FD, so I will know on the date of investment how much amount will I get in my maturity. So the first triangle is all about a fixed return investments. So these returns are, as I told you, lower risk as well as lower return. So the next stage of the triangle is national pension scheme and mutual funds. So what is national pension scheme is, it is a scheme where you can invest a portion, you can invest an amount, and you can select whether you want to put it in shares or government bonds, or there are classifications. I want to put a part of my funds in equity, I want to put a part of it in bonds, so that you can give a classification, or you can give you can give a voluntary part where the fund manager will decide how your funds will be allocated. Once you put it in NPS, there is no fixed return in NPS because all your investments will be put in shares or bonds. So your returns depends on how the shares are performing. So this is about NPS. We are going to see in depth about each of it in the next slide. All right. So this is NPS, and mutual funds is something where all the money of one particular mutual fund is pooled into shares. So you put some 1,000 rupees in, let us say you put Axis Blue Chip Mutual Fund. Okay, so Axis Blue Chip Mutual Fund will have some 20-30 will have their money invested in 20-30 shares. For example, Axis Mutual Fund has invested in shares of all the leading banks. So your money will be added to the shares of all those banks. So your return will depend on how those shares perform. For example, Axis Mutual Fund is invested 50% in HDFC Bank, 30% in Axis Bank, and 20% in Yes Bank. So your returns will depend on how the share prices of HDFC, Axis, and Yes Bank are performing. So this is about mutual funds. So this is of a medium risk. So the next part we go is shares or cryptocurrency. So what is shares? Shares is equity shares. So there are various ways in which you can do share trading. Our common understanding is share trading is risky. See, there are a lot of ways. For example, there is an intraday trading where you can trade, where you buy a share and you have to sell it in the same day. That is called intraday trading. And there is short-term trading where you can buy a share and sell it within a period of a month or two. That is within your purview. There is no restriction. So that is a short-term trading. Or the third category is you buy a share and you hold it for a year or two, so which is called a long-term trading. So these are all types of trading in which once you get a hold of it, you can in fact start making profit. So share trading is not about always losses, and there is also various categories like option trading, futures trading, forward contracts, and something like that. So when you think, okay, I want to put some money in share market, so how to go about share trading? So the first way is, if you are a total beginner and completely new to share trading, you can start small with mutual funds, because mutual funds is also a way of trading, because they put your money into shares but you are not monitoring the shares, because a fund manager will be allocated and the fund manager will be tracking the prices of the shares. So the first step into share trading is the mutual funds. Or you feel like, no, I have a small idea about how this share market operates. So I would like to go about myself. So what you can do is, there is something called paper trading. Paper trading is nothing but you download an app, let us say Money Control app. There are then you take a login with that, and you have to trade like you play a game. You don't invest the actual money. You just add some shares, you just sell, and you just do it in the app without investing any money. That is called paper trading. So you do a paper trading for one full month or a two, then you will get hold of how the share market is operating, and then you can start investing small amounts, and then you can go about investing huge amounts. So this is about paper trading. And in case if you are more interested, you can join any course, you can take up a course, and you can get full-fledged into share tradings. And you feel the third type of people, you feel like, no, I don't want to go for mutual funds, the returns are not much higher as it is in share trading, but I don't want to do paper trading and then get into shares either. I don't have that time or the luxury of it. So what is the way we can do it? There are some portfolio managers, there are some institutions, private institutions, which provide services like the portfolio management services. They handle your demat account, called the demat handling accounts. So what you have to do is, you have to invest with them. They will handle your demat account, they will give you advices. So you have to pay a percentage of your profit and commission to them, so they will be handling it on your behalf. This is totally legal in India. So these are the ways in which you can trade in shares. So next is cryptocurrency. So what is cryptocurrency? Something which is more happening in India right now, happening in fact in the world. So cryptocurrency is nothing but trading of the currencies. If you look at India, uh, for share trading, there is a regulatory called the Securities and Exchange Board of India. But for cryptocurrency in India, there is no proper regulator till date. But in foreign countries, it is now a trending topic. So if you ask me about cryptocurrency, I would say it is more volatile and more riskier than shares. Unless you know in depth about cryptocurrency, I would not suggest you to go and invest your money in cryptocurrency. And how to go about cryptocurrency is, there are a lot of apps with which you have to link your account, and then you can start trading in cryptocurrencies. The type of cryptocurrency are like, there is Bitcoin, there is Dogecoin, there is Ethereum, and there are many other cryptocurrencies. So now we saw about the types of investments available. So what are the risks and what are the returns in each investment? Okay, so we will see what are the risk and returns of each investment. All right, see, here I've given the rates of the investments, which is an approximate figure. This is not the exact rate. Some vary, depends on the banks or the institution with which you invest with. And the last three category is totally based on market situations. So I am giving you on an average rate of return. So do not take it like, okay, NTS, if I invest, I will get exactly 12%. No, it is just an average amount. So the first one we are looking here is FD and RD. So we know that we can go to any bank, any commercial bank. You can do it through net banking. You can invest in an FD or RD. So what do you get in an FD or RD? It is now getting very low. So it is somewhere around 4 to 6%. If you go to some society or a trust and you invest your money, you may get somewhere around 10%, but that is much riskier and there is no guarantee of your returns. So when you go to FD or RD, you get some 4 to 6% of returns. So what is the lock-in period in an FD? See, generally FD, when you invest, they ask you for the tenor. You can invest right away from 15 days, 1 year, 2 years and everything. If you want to put your RD in a tax saver, so I put some 2000 rupees every month in an RD, and I want to claim the 2000 for my tax deduction. In that case, the RD is locked in for 5 years. So I cannot withdraw the RD for 5 years. So that is what a tax saver implies, and that is what a lock-in period is all about. So for tax saver FDs, there is some time limit of 5 years. And if I invest in an FD and RD, do I get a Chapter 6A deduction? So what is Chapter 6A deduction in first place is for any individual, any person, while filing your tax return, you will get a deduction of up to 1,50,000 for ATC deductions and some other Chapter 6A deductions, that is collectively known as the Chapter 6A deduction. So in this case, if you invest in an FD or RD, which is particularly termed as a tax saver, at that point of time you get a deduction. Okay. So now the first step is over. I have invested. So after 5 years, I am redeeming the FD amount. So whether that redemption amount is taxable, only the interest amount which is earned on the principal is taxable. All right. So only the interest is taxable. So the second low risk investment is the PPF, which is the Public Provident Fund. So Public Provident Fund is something which is giving an approximate of 7.1 percentage in today's time. So it has a lock-in period of 15 days. So I invest every year. Okay, so today I invest. From today for 15 years my money will be locked in, and at the end of 15th year I can redeem the entire amount. Okay, and the investment which I make for a PPF, I get a Chapter 6A deduction. And whatever proceeds I get, see, I invest some 5,000 today, I invest another 5,000 in the next year. So the interest which is accrued year on year and my principal portion is fully exempt from tax even after 15 years. So there is no tax at all. See, this is commonly known as the triple E criteria, which is exempt, exempt, exempt. My investment is exempt, my returns are also exempt. So PPF is fully exempt, which is a good plan if you look at for a 15-year time frame. So the next one is National Saving Certificates. So what National Saving Certificates is something which is fetching me around 6.8% of interest. See, these funds are all the FDs, PPF, NSE, and the government bonds. If you see, these are all interest rates which will be specified at the time I go and invest. So I will know how much I will get at the end of my investment tenure. So in NSE, if you look at, my lock-in period is 5 years, and for this also the Chapter 6A deduction is allowed. Only the interest earned at the end of the period is taxable in my hands. And the next one is government bonds. See, what is a government bond? There are a lot of varieties of government bonds. There are tax saver government bonds. There are government bonds without a lock-in period, which is not a tax saver, like the Tamil Nadu Power Finance FDs are there. And one important thing is, like I told you in the previous slide, there is something called a sovereign gold bond. Sovereign gold bond is nothing but a paper gold. So instead of buying gold jewelry, I buy a bond which is equivalent to gold. I should have a demat account. I can apply online and I can buy the bonds. So my lock-in period for gold bond is actually 8 years, and for tax saver bonds is 5 years, and for non-tax savers I don't have a lock-in period. So more about gold bonds. Once I apply for it, I will my rate will be the RBI specified rate. So they will have a time frame within which they will the RBI will put up a notice that they are selling gold bonds. So in that time, what is the subscription price? For that, I have to subscribe. For example, I buy 10 numbers of shares of gold bond. So 10 into the rate specified will be 4,500, for example. So 10 into 4,500 will be my value of investment. So this has to be held for 8 years to get a tax exemption. So when I put this amount, after 8 years, whatever appreciation that gold value has will be my profits. So after 8 years, when I withdraw, I don't have a tax on that profit. In case I want to withdraw in between, I can withdraw from 5th year to 8th year. So when I withdraw at that time, I will be taxed on my capital gains. So this is about gold bonds. Apart from the appreciation in the gold bonds, I also get 2.5% yearly interest on my amount of investment. So this is gold bonds, and there are other bonds also in the government. So why many people go for government bonds is there is a guarantee and there is a security that there will not be any future problems in redemption. But at the same time, since the risk is low, the returns are also restricted to a lower rate. And coming to the next one, NPS. This is National Pension Scheme. About NPS is the one disadvantage of NPS is I start investing today till my 60th year, which is my retirement. I cannot withdraw my funds from NPS. There are a few criterias where I can withdraw, which is like child's marriage, etc. There are a home loan. If I want to repay my home loan, I can withdraw a part of my funds. So there are only a very few criterias where I can withdraw before 60 years. Else, my total investment will be locked in for 60 years. So what I do in an NPS is I start investing a particular amount, let us say 5,000. Every year I have to be paying 5,000. So once I start paying 5,000, this will get accumulated. And where is it invested is while I start investing, I have to give a declaration whether I want to put it in this allocation, or it can be voluntary where the fund manager is going to decide. So if it can be a mix of equity, it can be a mix of debt funds also, it can be a mix of bonds. So my returns, how will it be? It is not a fixed percentage. For example, I choose equity. Okay, so my investments will get invested in share market. So whatever amount, whatever value of the shares it is at my 60th age is what I will be getting. So this is not like any FD or RD where the amount is fixed. I will get this plus an interest.
Hey, you're on mute.
If, yeah, hi. Hope everyone is hearing now. Sorry. So hope no one, I don't know when it went on mute. So I think everyone heard about what is NPS. So in an NPS, once I invest my funds, at the age of 60, I will be redeeming 60% of it as a lump sum amount, and the balance will be given as a pension month on month. I cannot redeem all my 100% on the day of my retirement. So, the amount which I get as lump sum, that is partially taxable. The other amount is exempt from tax, which means I will not be taxed on that part. So the next is ULIP. So what is an ULIP? Unit linked investment plan. Unit linked insurance plan. So what is ULIP is? It is a mix of investment and an insurance. For example, I subscribe for a ULIP for 5-year time period. So what happens is every month I invest 5,000. In that 5,000, a part will go for my life insurance premium, and a part will go and get invested in equity. So that is how a ULIP performs. So I get a double benefit where I get an insurance cover. At the same time, I also get my equity investment. So ULIP is again tax exempt, and it is also allowable under Chapter 6A. If at all I pay a ULIP premium of more than 2,50,000 in one financial year, my maturity amount will get taxed. Otherwise, ULIP is fully tax exempt. So the next one is mutual funds. So mutual funds is basically without any lock-in period. There is only exit load if I see when I put it in the app, or when I put an application. Let us say I put a mutual fund for 12 months. If I redeem within the 12 months, there will be only a small penalty fee which will be charged, which is called the exit load. Otherwise, there is no lock-in for a mutual fund. But I want to put a mutual fund, I want to have a tax benefit in the mutual fund. Then it is termed as ELSS, which is called equity linked savings scheme. So any mutual fund with a tax benefit is called ELSS. So ELSS have a lock-in of 3 years. Some plans have a higher lock-in also. So basically, ELSS will have a 3-year lock-in period. So only if I invest in an ELSS, I get a tax deduction. Otherwise, my mutual funds doesn't have a tax deduction. And what about my income which I earn from mutual funds? See, any investment for that matter, the taxability which we see is for a financial year, which is from April, for example, April 2021 to March 2022. So this is going to be my financial year. So that is how my income is calculated. So for my mutual fund, if my equity investments is redeemed, okay, so I invest in a mutual fund and I redeem it within a period of 12 months, I will be taxed at 15%, which is called the short term capital gain. If I hold it for more than 12 months, then it will be called as a long term capital gain. And if my gain exceeds 1 lakh, then I'll be taxed. So if my long term capital gain is less than 1 lakh, I will not be taxed. So this is about mutual funds. So we've seen about the various categories of investments available in the market. Apart from this, there are many government schemes also. There is something called the Suganya Samriddhi Yojana, where you have a girl child, you can invest a particular amount every year. You can start from the first year of the baby's age, okay, and the period of investment will be for 15 years from the date of investment, and you can redeem it at the 21st year. And there is also a partial redemption available when the girl attains the age of 18. So this is very useful for people who plan for the child's education or the child's marriage. So this is again exempt from this scheme is allowable as a tax deduction. So this is all some wonderful government schemes which can be used. So when you plan, you can just think like, what is my future needs? Okay, I have to save something for my girl's education. The best scheme is the Suganya Samriddhi Yojana. All right. So we have seen about the various types of investment. So what apart from this, there are other investments which is not a liquid investment where I cannot redeem it quickly, like investment in property. I can start my new business, or I can buy gold jewelry. So investing in a property, let us say I buy a flat, so I can have a rental income. When I go for a home loan for a flat, I can claim that as a deduction. So these are all the advantages of owning a property. And then investment in business and gold jewelry. And coming to gold jewelry, see, when we buy a gold jewelry and actually when we sell it, it is taxable. But most of us are ignorant about it, and we are not accounting it. Selling of gold jewelry attracts capital gain taxes. Okay, so this is about my savings part. So now, okay, so I have put up a budget, I have allocated my savings, and I'm putting it in an investment. So 2-3 years have gone, so I'm like, okay, I've invested this much in FD, I have invested so much in mutual funds. So at the end of 5 years, I'm going to get this return. So is my job over? No. Next comes my wealth management part. It is not enough if I keep allocating and investing. I also have to manage my funds. So how do I go about it? The first thing is I have to monitor. Once I put all my savings in various portfolios and diversify it, I have to track how it is performing. Let us say I put an FD, I have put a huge amount in FD, and the government has announced, or the banks have announced that their FD rates have gone down from 6% to 4%. So will I get the return which I was having in my mind? No. So I have to keep reviewing it. Or I put some amount in a mutual fund which is predominantly having the shares of pharma companies. Okay, so now pharma companies have gone for a big boom. So I'm saying, so I expected this much amount, but since the share values of all the pharma has gone up, so my mutual funds is going to fetch me more. So I have to monitor my funds. So not only the funds, let us say you are having a home loan or a car loan. So my interest rate is the highest in the market. Okay, I am paying some 8%, while my colleague has loan with some other bank is paying 6.5% only. So at that time, see, home loan is not a short term affair. I'm going to pay it for the next 20 years or so. So when it is the same case, I will be able to save 2% or 1.5% on a huge capital, which is a huge saving for me if I shift. So we have to see whether I will be able to shift from the expensive bank to a better rate provider. So these are all the things which we have to monitor when we come to your investments or your loans. And then we have to diversify. For example, before watching this webinar, you've been like, okay, I am saving 20%, but I've put everything in one basket. I've put everything in FDs. I'm paying only RDs every month. If that
I think you went on mute.
okay, I'm sorry. One second. Yeah, so you have to start diversification. So once you have started saving 20% every month, but I'm putting the same but I'm putting everything in FD, I'm putting everything in only mutual funds. No, you have to start putting it in various baskets, because we cannot have all your savings in one basket, which can in turn become risky. So this is about monitoring and diversification. Okay, one second. Yeah. So the next step is once I monitor, there is something called adherence. So for mostly about for salaried employees, okay, so you have an investment plan, you have taken home loans, but you have not given your declaration to the HR. So what happens at that time is, the proper tax will not get deducted, and it will your salary will be the tax will not be deducted, and at the end of your term you will have to pay a huge amount of tax. So let me give you an example. See, there is a friend who earns 50,000. Okay, so what she does is, her salary is 50,000 per month, and in a year she is having a tax liability of, let us assume, 35,000. Okay, so in a year my tax liability is 35,000. What happens is, what your HR will do is, this 35,000 divided by 12 they will put. Okay, so the amount. Hello. Yeah, 35,000 is my tax liability. At that time, the HR will divide it by 12. So, assuming 2,900 is per month tax. What the HR will do is, from the salary of 50,000, they will reduce 2,900, and they will credit the balance of 47,000 to your account. So when you have a salary of 50,000, you will get a credit of only 47,000, because the balance 2,900 will go for a tax. Now, actual scenario is, even though I earn 50,000, what happens is, I have a home loan, I have some other LIC investments. So in that case, I will have a lot of deductions, but my tax liability at the end is only 15,000. All right, in one full year is only 15,000, which comes to 1,200 a month. So what happens is, in the second scenario, HR what will do is, once you give all the declaration, my total tax liability for a month is 1,200. So 50,000 minus 1,200, they will pay you 48,800 in your account. So in first scenario, when you do not give any declaration, you will get a bank credit of 47,000 or 46,000. But in the second scenario, you will get a higher amount, which is 48,500 or 49,000. So what is the impact of this? What happens is all the declarations you will tell your auditor while you are filing the returns. So when you file the return, the declarations will be put and you will get a refund. Many people assume that refund is my income. No, refund is something like you lend your money to the government and you get it back while you are filing the return. So that is your money which is held with the government over a period of more than a year, and at the time of filing you get a refund. So instead of that, you can save at least you save 500 a month. That is going to be of a huge difference. You can in fact start a mutual fund with 500. You can start a small RD with 500. So instead of declaring it all only to your auditor towards the end, once you declare to your HR in the beginning itself, your TDS will get managed. This tax deduction right is called the TDS. So this is all about prompt declaration. So the next step is I have to adhere to the timelines. So if my due date for filing return is July 31st, it is better you file it by July 31st, because once you go beyond that date, you will be charged interest penalty for late payments. And for business people, there is no there is something called an advance tax. So once you assess this is my total income, so business people might not know this will be my fixed income, because in salary they are giving you a CTC, they are giving you a they are going to give you a formal offer letter in which you will know the salary. But for business people, you have to evaluate your approximate amount, and then you have to pay advance tax as per the timelines given by the government, so that you don't have to pay any extra interest. Okay, so this is about adherence. This is about adherence to your timelines. So what next? You have to have caution. So what is caution? See, you operate a lot of accounts. You have two demat accounts. You have one in Grow, one in Zerodha. You have a 2-3 savings account for, and you have a lot of investments. Please check whether for all your investments, whether have you filled up a nominee. Okay, so this is one important criteria. And apart from this, you have a lot of accounts, and everything is now in internet. So whether your passwords is known to someone in the family, especially your spouse, because for safety reasons it is good that the passwords be written maybe in a diary and kept between you and your spouse, and definitely not be stored in a phone because of the security issues. So these are the caution you have to adhere to when you look at a wealth management part. And next comes one important criteria, which is the financial security. So how many people in the crowd have a proper life insurance? So many people will be thinking, yeah, I have a LIC insurance. See, if you look at LIC, it has very good returns, very good saving schemes. But when you look at the sum assured, they do not provide the actual benefit of a proper life insurance coverage. If you go for any private institutions like HDFC Life, there is ICICI Prudential. So if you go for them, the sum assured will be somewhere around 1 crore. See, again, it depends on the sum assured amount which you take. Okay, so when you go for a life insurance, please do not mix life insurance with your investment. So when you pay a insurance premium, you assume it is a sunk cost. I am not going to get back that insurance, but it is for the security of me and my family. I am going for a life insurance. So hope everyone is having a life insurance. If not, please look into your financial position, and please reconsider on thinking of taking a life insurance, because the earlier you take a life insurance, the lower the premium you will be paying. So if you are at 40 and still you don't have a life insurance, the premium amount will be much higher than the amount which you would have paid if you had taken the policy when you were 25 years old. Okay, so life insurance is one part which provides financial security to you as well as your family. And the most important part which many people would have felt during the pandemic is mediclaim insurance. For most of the salaried employees, the employer itself will cover the mediclaim. So for people who don't have a mediclaim insurance, mediclaim policy, please look at various policies. There are many good policies in the market like HDFC Ergo, there is Star Health Insurance, and a lot of things. Please take one mediclaim insurance for you and your family members. Okay, and the last part, which is a crucial one, is to plan for your retirement. So most of the people right now are working in private sectors where they don't have a proper pension scheme or retirement plan. Though every employer will deduct a PF and they will give you a lump sum amount while you retire, that amount is going to be a lump sum, and with the inflation, that is not going to be enough for you to manage your expenses once you retire. So retirement funds, you have to start early. You have to include it as part of your savings scheme now itself. At least when people be at the age of 35, or maximum when you are at 40, at least you have to start thinking about your retirement plans. It can be investment in LIC, or you can buy a second property where the rental income can be your retirement fund, or you can start a side business which will have a gestation of 5 years, and later on it will keep generating money for you. So that is about your retirement plan. And one important part is the wealth creation for your next generation. So all along we've been looking at how we are going to create wealth for ourselves. So after us, we have to leave behind a legacy for our next generation. So this at this type of a society, most of the people are educated, and the next generation do not need any educational backup. So one good thing we can give them is the monetary backup, which can be in a form of a property, which can be in a form of jewelry, or you can create your own business and leave it behind for your children. Okay. So going to the last part is about tax planning. So for all individuals, there are a lot of tax deductions available, which is for salary. There is a standard deduction of 50,000, which you can claim. And if you have a house property and you receive a rent from it, okay, so you're not staying in that house, you receive a rent from it, you can claim 30% straight deduction from the rent amount. For example, you receive a rent of 1 lakh, you pay tax only for 70,000. 30,000 is automatically exempt by the government. And once you have a house property, if you go for a home loan, you can claim the home loan interest and the municipal tax which you pay for your house property, that can be claimed. And if you don't have a house property, or if you have a house property which is located far away and you're staying in a rented place, you can also claim HRA exemption, which has to be declared to your employer. Or if you're a business person, again you can file it while you file your income tax return. Other than that, there is something called Chapter 6A deductions, of which the main thing is Section 80C, which has a limit of 1,50,000. So this is a very huge net where your home loan principal amount, your life insurance premium, your LIC, your tax saver mutual funds, tax saver FD, your children's tuition fee, all these amounts are will be covered under this 1.5 lakh. You have an investment for 3 lakhs also, you get a deduction only for 1.5 lakhs. So apart from this, there is something called NPS. NPS is also covered under this net of 1.5 lakhs. Apart from 1.5 lakhs, how much ever you invest, you can also get a 50,000 deduction apart from 1.5 lakhs. And there is once you pay a mediclaim premium, you can claim it as a deduction under ATC. So the limit is 25,000 for an individual, and for senior citizen it is 30,000. In mediclaim, you can claim for yourself, up to yourself, your spouse and children, for 25,000, and for your parents for another 25,000. So in total you get 50,000, and for senior citizens you get an extra amount. So apart from that, when you go for when you pay donations to any of the trust which is which is a registered trust which has eligibility of the ATG, those donation amounts you can also claim as deductions. And you have taken an educational loan for yourself, for your children, those interest on educational loan without any restrictions on the interest amount can be claimed as a deduction. So we have seen about what are the deductions available. Now for salaried people, many of them ask me whether the new regime or the old regime is beneficial. My employer is asking for a declaration, so which one shall I give? See, the tax rates are different in new regime and old regime, because generally up to 5 lakhs, 2.5 to 5 lakhs, there is a tax, but there is a rebate for it. So up to 5 lakhs there is no tax. So 5 to 10 lakhs is one rate, and 10 to 15 lakhs is 30% for older regime. But if you look at new regime, it is again bifurcated as 5 to 7.5 lakhs, 7.5 to 10 lakhs, and 10 to 12.5 lakhs is a different rates. So there are variety of rates. So which scheme shall I opt for? See, of these deductions, if you have invested a lot in ATC, if you have home loans, and if you have many deductions, it is always beneficial to go for older regime, because if you opt for new regime, the tax rate is low, but you do not get any of the deductions shown in these in the slides. You don't get a standard deduction from salary. Your home loan principal or interest amount you cannot deduct. So the whatever salary you're getting, that will be taxed. So in case if you have deployed your funds in any of these investments, you can go for old regime. Okay, so this is about the personal finance. So hope this session was useful for everyone. So hope you guys find it informative. Thank you. So is there any questions? There is no question.
Thanks, Janani. It was very insightful. Actually, there is no chat option available in Teams app for now.
Okay.
So people, whoever has any doubt can unmute and talk.
Good afternoon,
Guys, if
ma'am.
you have any questions, please unmute and talk.
Yeah, good afternoon, ma'am.
Yeah, good afternoon.
Ma'am, this is Venkatesh from Tamil Nadu.
Okay.
Actually, I'm running a business.
Okay.
Could you suggest me what are the beneficial schemes to save the tax when it comes to a company like private limited?
Yeah, see, when if you have a business, you can claim all your business expenses. For example, you have a turnover of say 20 lakhs, and for that turnover, you incur a lot of business, right? You rent an office, you pay your electricity bill, and you have you purchase your spare parts, or whatever line of business it is. You have some you have to incur some expenses. So all that expenses you can reduce, and the balance only you'll have to pay taxes. So apart from that, there are various schemes. If you register for MSME, you get a lot of subsidies and schemes from the government, and you get a subsidized bank rates also.
Okay, ma'am. Thank you, ma'am.
Yeah.
Ma'am, this is Ashwin.
Yeah, Ashwin.
Ma'am, you told that while investing in NPS or any other mutual funds, we have to decide the allocation.
Yeah.
And can we change it after allocating it? Suppose if I'm going for a 15 years, for a period of 15 years, can I change it on my 8th year?
Yeah, you in case of NPS.
Ma'am, you are muted.
Hello. Yeah, you can hear me now.
Yes, ma'am. Yes, ma'am.
Yeah, you can change the allocation in case of NPS, because you have to monitor and then you can change it.
Okay, ma'am. Thank you.
Yeah.
Hey, Praveen here.
Yeah, hi.
So, what do you think about real estate as an investment?
See, real estate as in it depends on what is your goal. Okay, so if you already have invested in mutual funds, or you first you look at the returns. So how much returns you want, and how much tenor you can take, and what is the amount you can invest. So if you have the bandwidth for investing in a real estate, or you can go for a loan, you can buy a property and you can generate income from that. So it all depends on what is your goal. So if you want to create an asset, or if you want to take a loan so that you can save tax, then real estate is a good option. Or if you already have so many LICs investments, where you have this 1,50,000 covered, and you already have a property from your family, if you don't look at other options, then you can go for a real estate. Always there is appreciation in real estate.
Okay, thank you.
Yeah, welcome.
Anyone else who have queries or doubts regarding investments? Yes.
Okay, so hope no
Hello,
one else is.
madam.
Yeah,
Madam Raghavan here.
yeah,
Actually, you told about prompt declaration, no, regarding that
yeah,
declaration to the
prompt
company.
declaration, yeah,
You have
correct.
given the two. You have given the two example, no. Can you just tell the once again the two example difference?
See, prompt declaration as in, see, you are working with a company, you have to give declarations about all your investments. For example, you have taken LIC, you have taken a mediclaim insurance.
Okay.
All those declarations you have to file with your employer, so that while calculating your tax and deducting it, they will do it correctly, and you don't have to pay any extra tax later on, or you don't have to claim a refund in the future.
Okay. Okay.
Hello, ma'am.
Hi, yeah.
I'm Gokul, ma'am. I'm a student.
Okay.
I was going through the investment plans. Then I saw SIP, ma'am, SIP funds. While I was going through that, I got to know many types like mid cap, multi cap.
Yeah.
Like, can you state the difference, ma'am? Mid cap, debt fund.
You went through debt funds. Sorry, I didn't hear you clearly.
I went through the SIP schemes, ma'am.
SIP. Okay.
So in that many categories were stated like mid cap
Okay.
and debt, debt fund, equity fund,
Okay.
multi cap like that.
Yeah. Okay. See, in shares, I mean, in a mutual fund, you take, there are a lot of categories. Like there is a equity fund, where most of their investment will go into share market. Okay, they will buy shares of any company. They will invest in NSE or BSE. If you take debt oriented mutual funds, what they will do is, there will be a lot of debt instrument, which is DEBT, debt. Okay, so debt
Yes, sir.
instrument, they will have a many investments will be there in the market. All your mutual funds will be allocated to the debt funds, which is some company, instead of going for shares, what they will do is, they will raise something called a debenture. which means they want money, but they don't want to give it as shares. In that case, they will issue debentures. So what the mutual fund manager will do, they will buy the debentures. So that is called a debt oriented fund. If they invest in a shares, it is called as equity oriented funds. So there is debt and equity. In equity, there are many categories. There are small value stocks. Okay, the value of the shares is only 10 rupees, 20 rupees. Those are all called penny stocks. There are some stocks where the value is around 2000 rupees, 3000 rupees. That is called the large cap fund, which is large market capitalization. Okay. So if your mutual fund is concentrating on large cap funds, it means the portfolio allocation in the mutual fund will only be of big companies, like they will have the shares of Infosys, HDFC Bank, and shares which has a higher value. So that is a large cap fund, and mid cap is somewhere between some 500 rupees to 1000 rupees trading shares. So you can choose your mutual fund allocation based on how you want. You want to put it in large companies or you want to put it in small companies. So that is about large cap and mid cap allocation.
Okay. Ma'am, I have another doubt.
Yeah.
As a beginner, instead of investing in shares, when I invest in FT, ma'am.
You can invest in FD is what you're asking, right? FD.
Nifty, ma'am. Nifty.
FD. See, as I told you, FD is going to give you only a fixed percentage of interest. Now, if you go to any bank, they are not giving you more than 4 or 5%. The maximum is 5% return. So you invest 10,000, you are going to get just 5% in a period. So what happens is, if your goal is long term, okay, so over 5 years you want to accumulate something, FD alone is not sufficient. Over 10 years you want to accumulate your wealth, FD will not serve the purpose. So to begin with and to be risk free, you can start with FD. If you are comfortable, you can go for mutual funds. If you feel shares are risky, you can just go to the internet. You can download few apps. There is a Grow, there is a Zerodha, and there is Upstocks. Okay, so you can download these apps. They are giving you a very good analysis of how a mutual fund is performing and what are the shares they are holding. If you take one mutual fund, they will hold 5% in HDFC Bank, they will hold 15% in Infosys Limited. Like that, they will have holdings. So, and they will also put the percentage of return they have generated over years. You should not see just 1 year return. You can see the last 5-year return or any long term return, and then decide where you can invest.
Ma'am, I was asking about Nifty, ma'am. The top 50 companies.
Nifty
Yes,
50.
yes,
Okay. Yeah, you can. Okay, I heard it FD. I'm sorry. Okay, so you can as well go to Nifty, because Nifty are all large cap companies, and they are the top performing shares in Nifty. So you can as well go. But before you before you just invest in that, you can look at the analysis of how they were performing in the recent 3 or 4 years. Because the last 1 year alone, if you look at, all the shares were performing differently because of the COVID situation. So you have to have an analysis of the last 5 years before you invest in any shares.
Okay, ma'am. Thank you.
And also look at the future prospects, like for example, all the pharma, okay, the pharmaceutical companies, already they are in all-time high. Okay, so if you go for pharma, already they've earned through the COVID. So if you look at the future, we don't know how much they can thrive in the market. So accordingly, you have to make your analysis and invest.
Okay, ma'am. Like electric automobile. Ma'am, that's the future.
Yeah, correct, because they have a better future, because that is more evolving.
Yes, ma'am. Thank
Yeah.
you.
Thank you.
Journey. This is Damodar.
Yeah, hi. Yeah.
Hello.
Yeah, hi. I'm able to hear.
Thanks a lot for and really great insights. So much information in detailed. Us.
Yeah,
We're very
thank you.
happy your time today. And, yeah,
Sorry, your voice is not clear.
if you don't mind, you can tell your contacts if possible. I think you are into the investor education and you're taking care of the personal finance
Yeah,
and
yeah.
tax plan. So if you share your number, if students really
Yeah, I'm sharing my
you
mail ID and
contact.
my number. If anyone has any queries or anything regarding the income tax planning, anything, uh, you can put a mail or you can put a WhatsApp message. Thank you. Yeah, hope everyone is able to see.
Your participants kindly can number and email ID. Get in touch with. Yeah. Rani?
Yeah, yeah. Thank you, everyone. Thank you so much for attending the session. It was good to have you all here. Thank you so much.
Thank you. Thank you.
Thank you, ma'am.
Thank you, ma'am.
Please make a note and the college will update every Sunday's webinar, and also we are starting so many practical sessions. Every month, one new batch will start on different aspects. You can get in touch and register for the training also. Thank you. Please make a note and you can leave from the session.
Yeah, thank you. Bye.
Thank you, Janine.